Hello and welcome to Fundu Money. Here we are going to be discussing the topic, the best time to sell a mutual fund, or the right reasons to sell a mutual fund. And the background for this is that most of the focus of mutual fund investing or any other investing is getting the right investment at the right time. You buy it, but to think of it, to realize the gain, you have to sell your investment at the right time, and you have to sell it for the right reasons. Now, in our country, in India, investors typically either sell too early or they sell too late. They hang on to investments as if it is their marriage jewelry. So if you sell too early or you sell too late, you don't get benefit of that investment, mutual fund investment, or for that matter any investment. Here we're going to be focusing on mutual fund investments, and we're going to be talking about the right time and the right reasons for selling your mutual fund units. We're not talking about selling everything off. We're talking about selling a partial amount or a reasonably large amount, and we'll basically be discussing in detail, but we'll give you an idea right now about some of the things that we're going to be talking about. First is we're going to be talking about underperformance, when your investment is actually consistently underperforming. Then about fund managers exit. That's one more reason why you should be considering an exit. You had bought the mutual fund because the fund manager, the star fund manager, has been doing well. So next is, of course, incompatibility with your general profile and risk profile, including your risk profile. Markets have gone up and down, and because of which your mutual fund investments is no longer compatible with the original risk profile that you had or your general financial realities, right? So that's the third point we'll be discussing in some detail. And then of course, a goal for which you are investing or you had invested is now approaching its pretty near, and you want to generally secure the gains that you have made. And then of course, the investment has run its course. It's probably not going to do as well, or whatever you wanted to achieve has already been achieved, and booking some profit or fully the profit makes a lot of sense. And lastly, of course, there's a change in the scheme's investment mandate, which typically is unlikely to happen, but if it does, it probably warrants a thought, a little bit of thinking that you need to sell off your mutual fund investment. So these are some of the things that we'll be discussing in some more detail. You can also check out the edited highlights in the description section. We'll be back with the details in just a little while. Welcome back. Welcome to Fundu Money. We are discussing the right time to sell your mutual fund investments, the right reasons to sell your mutual fund investments. And the first most important point, which is the most obvious thing, is when your mutual fund investments are underperforming. Now, the whole word underperforming, people make some very, very common mistakes which you need to be very aware of, is that when you come to the determination of underperformance, you need to do it the right way. So basically, you need to compare your mutual fund investment with the benchmark. How has it been doing with the benchmark? And it has to be consistently underperforming, because if it is not consistently underperforming, then you'll be exiting it for the wrong reason. So basically, you have to see that it's underperforming over a consistent period of time. It's about 18 to 24 months for equity funds, and if you're doing an annual review, then you'll catch the underperformance basically for a debt fund in the annual review, and maybe you would want to make a change. You can consider that. So you also need to compare it with your other similar mutual fund investments, not your investments, but mutual fund investments in the same category. How have other funds in the same category been performing? Sometimes market conditions equally impact, or shall I say not equally, but they tend to impact all the investments in that category. You need to be very sure that this is not what the case is. So you need to keep this particular thing in mind when you are looking at underperformance, and then you could look at whether you want to fully get out of that investment or partially want to do it. But remember, keep in mind the tax implication of moving out. So whenever you're selling out your investment, mutual fund investment, make sure that you've taken into account the taxation. So for equity funds, any investments less than a year is 15% capital gains are considered short-term capital gains. You pay 15% short-term capital gains tax. For investments of more than 1 year, you pay 10% long-term capital gains tax because they're considered long-term capital gains, and you pay 10% on long-term capital gains more than 1 lakh annually. So you need to keep that in mind. And of course, for debt investments, if it's less than 3 years, it gets added to your income and taxed at your income tax rate. Apart from that, if it's more than 3 years, remember the capital gains is considered as long-term capital gains, and you have to pay 20% on inflation indexed capital gains. So the proportion in which the inflation index has moved, it gets adjusted to your cost of acquiring the units, so it becomes lesser for capital gains purposes, rather tax purposes, and the capital gains becomes lesser, and you get taxed at a 20% rate. So these are things that you need to keep in mind. Remember, any investment which has got a mix of debt and equity, 65% and more than 65% in domestic equities, that's what is considered as an equity fund. It's taxed like an equity fund, and anything less will be taxed like a debt fund. So this is something that you need to keep in mind. Apart from that, the next point that's worth talking about is fund manager's exit. Suppose you had invested in a mutual fund based on the reputation of a fund manager and the fund manager's great performance. Now what happens is, if the fund manager has moved out of the fund house, then and the investment performance has started to suffer, or you think it's going to suffer, you might consider moving out of that mutual fund investment. But remember, you need to check out whether even before you're investing, you need to invest in a fund house which has got processes in place, and typically all large fund houses have that. But if you think that this is something that's going to have a bearing, it does. It's not as if it doesn't. A fund manager's skill and acumen is actually giving you more, slightly higher return. Some people love using the word alpha. So that extra return you're getting because of the fund manager, and if you think you're not going to be getting it in the future, and you're quite sure you've got evidence, maybe you should be considering moving out. Now, next is, of course, incompatibility with your profile. So it could be the markets have moved up or down. If it's moved up, so from a particular investment, from that investment class, although it's got enhanced in value, but the risk associated with the investment class is now going to affect your whole outcome much more. So suppose equity markets have run up, and anything that's affecting equity markets will now affect you even more. So if it goes down, the markets go down, your overall return of your investments is going to get impacted. So you might want to lessen it a little bit and come back to your original mix of debt, equity, gold, whatever, real estate. So that kind of a thing you want to do. In terms of mutual funds, it would be debt, equity, and maybe gold funds. So you want to, sort of get back the original asset allocation, if I'm allowed to use the term. So it's strategic asset allocation. This is the long-term mix that you want, unless of course that has changed for you. So you would want to do that and get back that thing, that initial mix. So you might have to sell a little bit of your mutual fund investments of the asset class where it has got enhanced. There could be individual developments. Suppose you have an uncle who's given an inheritance, and you want to you want to invest in high risk investments. So you might want to move up the risk ladder, or that of course was a joke in lighter vein, but suppose you get a bonus or something like that, which is more likely to happen than a rich uncle giving you an inheritance, then you might want to reconsider, you might want to reject your mutual fund investments, you might want to do that. Some adverse development has happened, and for a little while you want to take lesser risk, so you might want to scale down the risk of your investments a little bit. So this is something that you might want to do. Then of course, some goal for which you are investing, and now it's coming very near, you want to secure whatever gains you've made. Suppose you were investing for a daughter's higher education or some other objective, then what happens is, if it's like 2 years down the line and you want to secure the gains you've made through equity fund investments, you won't want to move part or wholly the money, or gradually you won't want to start moving the money into lower risk investment like debt funds. You can do that. So that's one more reason why you would want to sell a mutual fund. Sometimes what can also happen is investment has run its course. There was a particular theme of a mutual fund. Now that theme is not playing out well, or the investment is not doing as well. It's not underperformance. It's probably run its course, or it's not doing as well as you would expect, or you don't expect it to do as well in the future, or there are better alternatives. You're very, very sure of the other mutual fund investments. That is a time then when you can be looking at exiting the mutual fund investment. So that's when you won't want to partially or fully want to book some profits. The last bit is relating to investment mandate. Now, if the focus of the fund actually changes, you'll be informed about it. Fund houses actually inform you, and in the current dispensation, this is unlikely to happen very often, but because it's a cumbersome process. But if that happens, you get to know, and you're not comfortable with the new focus of the fund, or the asset allocation is changing, the mix of investments that they're going to do is going to change, and you get to know about it, then you can move out, and there's going to be no exit load for a window of time. You can actually act upon that and fully or partially get out of the investment. So these are some of the reasons. This is when these things happen. This is the time when you should be considering moving out of mutual funds. These are actually the major reasons. Some friend tells you to get out of mutual funds. Some expert, whether on in the internet or YouTube or whatever, or a television channel randomly tells you to get out of your mutual fund. That's not how you should be getting out. Selling is a very important part, because that's when you actually make the gain. So you need to be very smart about when you're getting out of it, because all the hard work that you've put in can go waste if you are not doing it for the right reason, or you're not doing it at the right time. So we hope you found this useful. If you've liked this, hit the like button and subscribe to our channel, and share this with others, and wait for our next presentation. Till the next time, take very good care of yourself, and goodbye.